Hello everyone, welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 7 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled Leader or Laggard, which is your stock? You can read the original post at samfury.com.
Today we're diving into Chapter 7 of William O'Neill's How to Make Money in Stocks. And he talks about this idea of separating the leaders from the laggards. I think there's a lot we can learn from that.
Absolutely. O'Neill really nails it when he talks about the psychology of investing. We get attached to stocks for all sorts of reasons. You know, maybe they've done well for us in the past, or maybe there's a company we just really believe in.
I totally get that. There's a company I'm super interested in right now, but sometimes it's hard to be objective, right?
Yeah, for sure. But to really maximize gains, we have to be able to step back and look at things rationally. You got to ask yourself, is this stock truly a leader, or am I just holding on for sentimental reasons?
Okay, so that's step one, detaching ourselves from the emotion. But then how do we actually identify these leader stocks? I mean, there are thousands of companies out there.
Right, and it's easy to get overwhelmed. But O'Neill gives us a really useful framework for thinking about this. He says to think of it like scouting for a sports team. You're not necessarily looking for the biggest names or the most popular players.
We're looking for the ones with the best track record, the stats.
You want the ones who consistently deliver results, the ones with the strongest fundamentals.
Okay, but, how do we translate that to actual stock characteristics? What specific things should we be looking for?
Well, first and foremost, strong earnings growth, and not just for one quarter. You want to see consistent growth, both quarterly and annually. Then there's return on equity, or ROE. That basically tells you how efficiently a company uses its capital to generate profits. And typically, leader stocks have a high ROE.
So they're making the most of what they have.
Got it. And of course, you want to see above average profit margins and robust sales growth. That tells you that their products or services are in high demand.
Makes sense. So it's really all about consistent performance across the board, right?
Yeah.
But wouldn't that mean missing out on some of those hot stocks that everyone's talking about?
Yeah.
I mean, how do we balance that popularity with these leader characteristics?
That's where things get a little tricky. O'Neill warns us about falling into what he calls the sympathy stock trap. These are companies that rise in price simply because they're in a hot sector, not necessarily because of their own merit.
Okay, so they're kind of riding the coattails of the true leaders, but their fundamentals might not actually be that strong.
Think back to the dot-com bubble. Plenty of companies soared in price just because they had .com in their name.
Right. It was like just being in that sector was enough. But a lot of those companies didn't actually have the substance to last.
So it's really crucial to focus on individual company performance, not just industry trends.
Don't just follow the hype. You got to do your own research.
And one of the tools O'Neill recommends for quickly gauging a stock's strength is relative price strength, or RS.
I've heard of RS, but I'm honestly a little fuzzy on the details. Can you break it down for me?
Sure. It basically compares a stock's price performance to the broader market over the past 52 weeks. So a high RS rating, ideally above 70, suggests that the stock is outperforming the market, indicating potential strength. On the flip side, a declining RS trend can be a warning sign.
So even if a stock is in a sector that's not doing that well, if it has a high RS, it could still be a leader.
Precisely. Now, O'Neill does mention that RS is a proprietary rating from Investors Business Daily.
Yeah, so what if we don't have access to that specific data?
That's a good point. But while RS is a valuable metric, there are other ways to get similar insights. A lot of stock screening websites or financial data platforms, they offer comparative analyses that can help you understand how a stock is performing relative to its peers or the market as a whole.
Okay, that makes sense. So we have options. Now, even the best stocks, they go through rough patches. What happens to these leaders during market corrections?
That's actually where their true strength is often revealed. Leader stocks, they might actually correct more sharply than the market average. They tend to have a higher beta, which means they're more volatile. But here's the key. They also tend to bounce back faster and stronger.
Because their underlying fundamentals are still solid, even if the market is freaking out for a bit.
So if you see a leader stock take a dip, you shouldn't necessarily panic. In fact, one of the most powerful signals that a leader is back on track is when it makes new highs after a correction.
Oh, interesting. I have to keep an eye out for that.
Yeah, it's definitely something to watch for. Buying opportunities often emerge within the first month of a breakout from a new high.
That's a great insight. I'm going to remember that. But sometimes we make bad calls, even with the best research. How do we know when it's time to cut our losses?
That's where discipline and a clear strategy are crucial. I know it's tough to sell a losing stock, but it's essential for protecting your capital. O'Neill have this rule, called the 8% rule. It's really simple but effective. If a stock drops more than 8% below your purchase price, it's time to reevaluate your investment thesis.
So we're not selling at the first sign of a dip, but we're also not holding on just because we're stubborn.
Right. It's all about finding that balance.
This has been incredibly helpful. I feel like I have a much better understanding of how to spot those leader stocks. So to recap, we're looking for companies with strong, consistent fundamentals, not just hype or hot trends. We can use tools like RS or similar comparative analyses to assess a stock's performance relative to the market. And even when a leader stock takes a hit, we need to remember that they often recover faster and stronger.
You got it. The key takeaway here is to be deliberate and objective in your stock selection. Don't get caught up in emotional attachments, and definitely don't follow the crowd blindly.
Really great advice. And I think for our listeners, the question to ponder now is, think about the stocks you currently own. Are they leaders or are they laggards? It's time to take a good, hard look at those portfolios.
I couldn't agree more. Thanks for joining me today. It's been a great deep dive.
My pleasure.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.